This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey folks, welcome back to the Human Action Podcast. Before we dive into today's material, let me put on your radar the upcoming annual Supporters Summit for the Mises Institute. This year, it's going to be held in Delray Beach, Florida on October 16th through 18th. We'll enjoy a weekend of camaraderie, educational enlightenment, and freedom revolution plotting. Economic and civil liberty have always been behind American greatness, and America cannot be great again if it's not free again. That's why this year's theme is Make America Free Again. Featured guests will include Lou Rockwell, Tom DiLorenzo, Joe Salerno, Guido Hulsman, and me, plus several other speakers. Our keynote speaker is going to be the popular Mises Wire contributor, libertarian journalist, and prolific author James Bovard. Registration is $475 per person, and you must be a Mises Institute member to register. For more information, go to Mises.org/SS25. Once again, that's Mises.org/SS25. Check it out. Hope we can see you there. Okay, folks, for today's episode, I thought it would be instructive and useful to go through some clips from a recent Tucker Carlson episode that featured Oren Cass. So some of you may know who Oren is. He's making waves in certain circles. He's been doing shows. He was on a different podcast that I host recently, and I'm thinking that may have been what launched his career. But he's been on The Daily Show. I saw him, it was literally the day I interviewed him on this other podcast. I was at the gym and saw him on CNN, so that was kind of funny. And but he recently was on Tucker Carlson as well. So Oren is the founder and chief economist for what's called American Compass. It's a right-of-center organization. And the specific thing that Oren is known for in recent years is he is a Republican conservative kind of guy. He was actually the policy director, I think was the exact title, for Mitt Romney's presidential campaign, or at least one of them. And yet he has rejected what he views as free trade dogma, that he refers to market fundamentalism that's embraced on some segments of the right. And Oren thinks that it's both wrong intellectually, but also it's been bad, for the U.S. worker in particular and families. And that's what he's aiming to change. So if you're familiar with Tucker Carlson's views, you can see why those two hit it off quite nicely. So you might be expecting, given this backdrop, that what I'm going to do in this episode now is just go through all the ways that Oren doesn't know what he's talking about. Free trade's awesome. Tariffs are idiotic, and so forth. I'm not going to take that tack, even though, to be clear, I am against tariffs. I'm a Rothbardian, right? I don't like taxes under any circumstances, but also for standard textbook economist reasons as to why tariffs make a country poorer on average, I still subscribe to all those views. But what I want to emphasize in this particular episode that I think would be the most helpful for this debate is that Oren is not a knuckle-dragging idiot, and he's not a liar, right? And I saw the reaction on social media. There were a lot of economists associated with free market organizations who, when they saw this interview, and I'm going to play you folks some clips in a few minutes here, that was their reaction. Like, some of them explicitly came out and said, oh, hey, I've been correcting Oren on these misstatements that he makes about Alfred Marshall and the history of economic thought when it comes to free trade and Ricardian comparative advantage. And he just keeps, now he's going on Tucker and saying the same stuff that's been debunked. This guy's just a liar at this point, right? I've seen statements like that. So I've seen the reaction. For example, there was an AEI economist, sharp guy, has a PhD in economics from Harvard, that he tussled with Oren several weeks ago, as I'm recording at this point, on some issue of comparative advantage. And the way Oren reacted to the AEI guy's response to Trump's Liberation Day, the scheduled tariffs and so forth, people thought that Oren didn't understand the first thing about free trade and comparative advantage and how it worked. And so that's actually the impetus for why I had Oren come on this other podcast that I host that's, catering to a financial audience. And we just went through all that stuff. And then when I posted a clip where he elaborated and said, well, this is what I meant. And it was clear. Yeah, he understands the basic blackboard demonstration of this stuff. And then, the way the economists responded to that clip also, they just kept, no, he doesn't get it. And he wasn't, Oren wasn't saying anything false in the clip. So my point right now is to say, in particular, because for those of you, I'm not going to show the clips here just in the interest of brevity, but if you go watch the full interview that Oren did with Tucker Carlson, it's clear that Oren, he's kind of like a Pat Buchanan, but nerdier, right? That he's very skeptical of the war hawks. And at one point he says something like, at this point, the experts have been discredited. And so if somebody says, well, hey, the people working for the State Department assure me that letting China into the WTO was a good idea and that free trade helps all Americans in the long run, and especially the workers. So why wouldn't we do it? That people can then say, oh, are you the same kind of expert in the State Department that said we should invade Iraq and stuff like that, right? So I'm saying Oren's overall policy views are very conducive to people who are sympathetic, to an anti-war libertarian type position, except on the area of free trade. And so rather than, in my view, strategically just say, no, those people are fools and casting them out, let's at least try to grapple them. And the last thing I'll say here as preface before we dive into the clips is, in particular, I think what really is a bad idea strategically is if Austro-libertarians who still support free trade, if when the people questioning this orthodoxy are pointing to certain trends in the U.S. economy, like why is it that we just keep having these huge string of trade deficits? And we'll see stats about like the productivity of labor in the manufacturing sector has stalled for the last decade, things like this. And that one type of flavor of response that I've seen from professional economists is to say, oh, no, the trade deficit, that's not a problem. That just shows how awesome the U.S. economy is. It's because investors want to get in on all the assets we're creating here. And so that's great. And so it reminds me of back when the Affordable Care Act, or so-called Obamacare, was being debated, that one type of right-wing conservative Republican response to the people complaining about, healthcare in America is ridiculously expensive. Some people can't get insurance. Even if you do have insurance and you pay a boatload for the premiums, then when you're actually sick and need it, you have huge copays and blah, 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 and deductibles. So one response to all that was to just say, oh, quit your belly aching. The U.S. has the greatest healthcare system in the world. This is why capitalism is awesome. And if you like socialized medicine, go to Canada where you're going to have to wait 3 years to get a hip replacement. And so they were confirming that, yes, right now the U.S., the healthcare system as of 2007 is laissez-faire, free market economics in action. And so I thought strategically that was a very bad idea because no, it wasn't. And I co-authored a book with ER Dr. Doug McGuff going through, it's called The Primal Prescription if you want to check it out, going through all of the huge interventions at the federal, state, and local levels in the healthcare and health insurance industries to show why, no, we don't have a free market in healthcare. What are you talking about? Right? Like, you imagine trying to buy a car and you have to pick out the model and then sign the contract, and now you owe them the money for the car, the dealership, and that's the point at which they tell you what the price is. That would be kind of they'll probably screw up the car market if that's the way it worked, right? Prices would be really high and you wouldn't be sure the quality. Well, that's how healthcare works right now, basically. Okay, so anyway, I'm saying I've seen that vibe a lot in the reaction from libertarian / conservative economists to Oren Cass in particular. And so that's partly what I'm trying to do in this episode is, again, I'm not going to agree with his policy conclusions. I don't think tariffs are a good idea unless you're going to use them to reduce income taxes. But per se, tariffs are taxes and that hurts Americans' welfare. But Oren is not the lying idiot that I've seen people explicitly call him on social media. And I want to just show you folks, where he's coming from, so that at the very least, if you're trying to grapple with people who think what he's saying makes sense. And again, one of the people who found him quite persuasive was Tucker Carlson. Okay, so if Oren is able to win over a big chunk of Tucker Carlson's audience, I don't think the response is to say, well, it's because they're all idiots. I think it's the idea of what is it that's driving this? And let's see if we can show them, oh yeah, you've put your finger on something that's a legitimate issue, but your proposed solution is not going to solve it, right? Last analogy I'll make, it's kind of like dealing with leftists who are worried about kids getting enough to eat or something, and that's why they want to have the government have food stamp programs and all sorts of. And I think partly the way to diffuse their concern is to say all the ways that the government, keeps people down with minimum wage and bad public schools and stuff like that. But also, to show, in a voluntary market, there'd be privately funded charities and there would be churches and to show the free society has ways to deal with the stuff you're worried about, as opposed to just saying, hey, if you starve to death, that's your own fault. Go get a job. That might be, strictly speaking, correct and better than what the status is recommending in terms of the NAP. But strategically, I don't think that's a good idea. Okay, so enough of the preamble. Let me go ahead and play. I've got 3 total clips for you folks, just so you can pace yourself mentally here. So here's the first one on Oren talking about the history of economic thought as it pertains to free trade.
Wait, can I say, why have I never heard this before? It's like the most interesting thing I've heard in a long time. So you're saying that our economic model was not primarily an economic model, it was an instrument of foreign policy. It was like the centerpiece of the global order, post-war global order. And it wasn't like designed really to help the United States as much as it was to preserve stability around the world. Is that what you're saying?
There are other people who say that. I've written an essay about it. It's called the free trade origin myth that kind of goes through the chapter and verse on all these various things.
The way it was presented to me as someone who was always conservative and for markets and repeated all the slogans and all that and was living in the world where like I didn't know a single person who disagreed, talk about a bubble, was that free market economics in the way that the United States was doing it was not really an instrument, wasn't even a theory. It was like a physics principle.
Right.
It's just true. Okay. So, and to the extent that you deviate from it, you get punished. To the extent that you hew to it, you're rewarded because like gravity, it's just real.
Right. And this is the fundamentalism.
But I had no idea that this was like the UN, something that people who are understandably like horrified by what they just gone through, the World War.
Yeah.
It was part of their reaction to that. And they're like, this will prevent that from happening again.
Yeah. And another good example is, so if you go back, so Samuelson is the key post-World War textbook. Mm-hmm. There's a prior textbook by a guy named Alfred Marshall, who's kind of seen as the father of like modern economics, right? Like Adam Smith is like the original guy.
Right.
Alfred Marshall is a British economist, probably the first one to actually be called an economist. No one would have called Adam Smith an economist back in the day. So Marshall writes probably the first economics textbook, comes out in like 1890. And he says essentially nothing positive about free trade. He actually has a whole section, the comparative advantage is this idea that, free trade, works out great for both sides. And it's attributed to a guy named David Ricardo, who was a great, early 1800s economist. Marshall has a whole section called The Narrowness of the Ricardians, where he specifically says, look, like Ricardo has this nice theory, has some good math associated with it, but it only works in very limited circumstances. It makes a lot of sense that Britain as a global empire is promoting it, but there are lots of people it doesn't work for. The Americans don't believe it. The Germans don't believe it. And he even has this hilarious footnote where he says a lot of these ideas basically seem to be used as a way for like people to put one over on the working class.
Okay, so just to warn you, this segment of the Human Action episode that we're going through right now is going to be the most technical, right? When we get onto later stuff, it'll be more news you can use for the current day. But here, I did want to take a few moments and just spell out what Oren's talking about, because it's this particular issue where some of his critics on social media were saying, here, he's had this mistake pointed out to him and he's just going around now. He's just a liar at this point. And that's not accurate. All right. I'll put links in the show notes page, folks, but this is Oren is referring to, he was part of this symposium at the Law and Liberty website. That's the Liberty Fund maintains. And so back in January of 2024, they had this forum allowing people to, go back and forth. And so Oren's lead essay was called Free Trade's Origin Myth. And he laid out a lot of the stuff that, he summarized there in the clip I just played for you. And then in response, Phil Magnus pointed out that, that if you go and read the context, for example, of that Alfred Marshall quote, you'll see Marshall is not chastising the Ricardians for the doctrine of comparative advantage. Instead, if you look at it in context, Alfred Marshall is chastising the Ricardians for their model of distribution of income, right? So David Ricardo famously had this approach to modeling the economy where there's, the capitalists earn profit, or we might call it nowadays interest. The landowners earn rent, and the workers earn wages, right? And so it's like the national produce or output is divided into those three classes, and people get paid their income according to the type of person they are and the economic function they serve. Okay, and then you can do things like say, so if the rate of interest is higher, then more of the output goes to the capitalists and less goes to the workers and stuff like that. Okay. And what are the principles governing, landowners who have really fertile land that's above the fertility of the last unit that's brought into cultivation? They earn this, extra rental payment and so forth. Okay. So Phil is right. If you go and, you look at one of the quotes that Oren presented as to say, hey, even Alfred Marshall threw the Ricardians under the bus and thought that they were kind of trying to pull one over on the workers. Phil is right that if you go and look at the context in Marshall's 1890 Principles book, yes, that it's true that Phil is correct. What Marshall's talking about there is more about the distribution of income modeling. And specifically, Marshall is upset, as I recall. In England, there were I think they're called the Factory Acts, like safety legislation and things like that were supposed to get away from Dickensian conditions at the factories. Okay, like after Charles Dickens, right? So, and apparently in those days, there were some conservative types who opposed this, what we would now think of as like progressive legislation and regulation of business on the, citing results from a Ricardian model to kind of say, well, hey, this is just going to, the workers' situations like this, and that's just kind of the way the world is, and you can't fix it with legislation. And this is just silly. This isn't going to do anything. It's going to be counterproductive or whatever. And Alfred Marshall thought that was wrong. And he thought, no, these people who are just opposed to things that would cut into the profits of the capitalists are pointing to this very simplified economic model that leaves out a lot of stuff. Okay, so Phil Magnus is right when he's saying Oren, when he grabbed a specific quote about Alfred Marshall not liking the Ricardo school. Phil's right that that's what he's referring to. He's not talking about the doctrine of free trade that's buttressed by Ricardo's demonstration of how comparative advantage works. If you got, two countries and there's two goods trading for each other, even if one country has the absolute advantage in both, it still benefits by specializing in the one that it has the comparative advantage in and then trading with the other country, right? However, and Oren did respond in a follow-up essay. The way these essay battles play out on websites is they often, one guy will write something, people will have rebuttals, and then the first guy gets to respond to the critique. And that's what happened here. And Oren, by the time if you read the whole exchange back and forth, it's crystal clear that no, Alfred Marshall did have a problem with the standard Ricardian model when it comes to free trade. And in particular, Marshall says that, hey, what the Ricardo's treatment of comparative advantage and it underpinning the case for free trade, that may have been valid for England at the time, which was the global empire with its navy and, manufacturing powerhouse, that yes, given England's position at that time, they benefited from having free trade. However, Marshall explains there are economists, for example, List in Germany, who are questioning this dogma. And they're saying, hey, that's kind of convenient. that England had protective tariffs in place. They called them the Corn Laws, for example, had, all this protection in place while they became an industrial powerhouse. Right? And then it was only after they achieved their dominance of the world that then they said, oh, you know what? Turns out tariffs are a bad idea. The mercantilists were wrong. Free trade for the win. And everybody should do this. Okay, because science. Right? And then also Marshall explains, and I'll put a link here, folks. This is all coming from, that's free online versions of his textbook that was originally in 1890. In the United States, the budding American economists also were open to this. And as you may know, Tom DiLorenzo has done a lot of stuff on this. There was a strain from the beginning, going back at least to Alexander Hamilton, in the United States of a, protectionist infant industries type mindset. That a lot of U.S. statesmen thought that was the way to go. So DiLorenzo didn't like it because that's one of the things like that Abraham Lincoln embraced. That was one of the causes for the war between the states, right? Was that the tariff of abominations and stuff like that, right? So again, I think they were wrong that the German economists and the American economists and the American politicians who thought a high tariff wall promoted your domestic industry and that made your country develop on better terms than if you had free trade. I think they were wrong. But Oren Cass is not lying when he says that's what was going on in terms of the economics profession, that it was not just this undisputed truth that, oh yeah, it was demonstrated by Ricardo in 1817 that free trade is optimal for everybody. That's not true. Okay. There wasn't this consensus in the profession. Okay. So that's what Oren's talking about. And then you can see why he thinks that's quite relevant. Saying, hey, geez, nowadays we're getting beaten over the head by these so-called experts telling us it's obvious that free trade is always the best for everybody, when some of us are wondering about, aren't there other things besides the simplistic arithmetic in the model, like the necessity for having a strong manufacturing base, perhaps also for strategic military reasons, things like that. Or in Oren's telling, well, if you have manufacturing that spurs innovation, right, that other things equal, you'd rather that your economy focuses on making computer chips rather than potato chips, even if they were of equal profit margins and stuff like that, and real wages for the workers and returns to the shareholders. If you had to pick between the two, he's saying, I would rather have the country that is the world's center for computer chip production. Okay. And that type of thing is not in the simple Ricardian model. And he was saying, and I'm not making this up, other economists have said that too. Okay. So again, not endorsing his perspective, but I'm saying he's not lying, and it doesn't help if economists just say, oh, this guy obviously can't understand a simple undergrad blackboard demonstration, when no, Oren's gone back to the original text and shown blah, blah, blah. Okay. Let me just speak a bit more on this issue of comparative advantage, given that the Human Action Podcast is largely devoted to economic pedagogy. Let me just explain this. And also, I will put links on this very podcast. I have gone through how comparative advantage works in case you never learned that. All right. So if you're just vaguely familiar with it, it's really cool. All right. It's a counterintuitive result. And if you've never seen it spelled out and just seen the beauty of it, you're in for a treat. So I'll put a link that I did that once here on the Human Action Podcast recently, and our production guy, did a good job doing the graphics and whatever to illustrate the numbers I was saying. So I think you'll enjoy that if you haven't seen it spelled out. But having said that, one of the issues that Oren has been raising, he gets a little bit at it in this Tucker Carlson interview, but he said it elsewhere, and he certainly says it on social media. And this is one of the things he spelled out to me in this other interview where I had him, is he's saying modern economists, especially if they're of the libertarian / conservative type that really champions free markets, he said when it comes to trade, they just have this default go-to of, they just cite comparative advantage as if that settles everything. And that's the only thing that matters. And he was saying the appeal to comparative advantage does a lot more work in their rhetorical arguments than they seem to realize. All right. And I think he's correct. And so let me just spell out a little bit what I mean here. Again, at the end of this, it's not that I'm going to say, and so if you think about it, tariffs actually do make workers richer. That's not where I'm going with this. But I'm saying Oren is right to say, wait a minute, these guys just telling me I'm an idiot for asking about this stuff, and that, just go reread Ricardo's 2-page demonstration of England and Portugal are trading wine and sweaters or whatever it was. That no, there's a lot more going on to explain what's happened in the U.S. over the last 3 decades. Okay, and so specifically when it comes to trade deficits, right? So if you just had the very baseline, simple Ricardian model, there's 2 countries and 2 goods, and the one country, is better at both in terms of absolute advantage. So the workers can make either of the goods with fewer labor hours than the workers in the other country. Prima facie, you might think there's no gain from trade there, that the wealthier or more advanced country should just decide of these 2 types of goods, how many of the one versus the other do we want, given how many workers we have, and just allocate our workers accordingly. But that's incorrect. That in general, the opportunity cost of making one of the goods in the rich country is going to be higher if you do it domestically than if you just import it from the other country. Okay, and so that gives the result that, you can just see, it's simple arithmetic, that if both countries specialize in the good where they have the comparative advantage and then trade the surplus with each other, you can, pick the numbers appropriately and just show how each person in each country gets more of both goods by engaging in trade. So it's crystal clear everybody's standard of living is higher if they specialize in trade rather than if they just have a closed border solution. Okay. And again, that's even if you build into the assumptions that one country, its workers are better at both goods, right? So that's showing the U.S. is not harmed by trading with Mexico or by trading with Bangladesh, even though I've seen, like, years ago, Pat Buchanan talking about NAFTA. Michael Kinsley asked him point blank on Crossfire, I know you're worried about these international bureaucrats and stuff, but if it was just a 3x5 postcard that just said the U.S. is going to have free trade with Mexico, would you be in favor of that, Pat? And he said no, because it would merge our economy with Mexico. It would bring us down to, the average level. Okay, so I think that view is wrong. All right, and the simple Ricardian model of comparative advantage shows why it's wrong. Having said all that, where Oren is coming from is he's saying the simple Ricardian model of comparative advantage, there shouldn't be a trade deficit. That's just showing, you specialize in one type of good, all your workers go there, you shouldn't have unemployed workers, they all have jobs, and it's just showing that, you send a bunch of goods and the other country sends you goods in return. So there's no trade deficit. It's just showing you how imports and exports can make your country better off than having no imports and no exports. It shows the benefits of trade, right? And so in this simple model, there wouldn't be trade. There's no money. It's just we send a bunch of goods across the border this way, and then in exchange, they send us goods this way, and it's a static model, so there aren't trade deficits. And now you can make it more sophisticated, and you can have a triangular situation where there's 3 countries, and there, if you're just using basic comparative advantage, then maybe there's 3 goods now, and each country just specializes in the one good, and then they trade with each other. Okay. And you can, depending on their consumers and what they want to buy and things like that, you can imagine a scenario where each country has a trade deficit with one partner, but then has a flip side mirror image trade surplus with the other country, so that each country vis-a-vis the rest of the world still has balanced trade, even though they have bilateral trade deficits with some countries and bilateral surpluses with others. That you could also explain with a simple model of Ricardian comparative advantage with, multiple countries. Okay. But even here, Oren's point is it doesn't explain why one country would have a trade deficit year after year after year for 30 years in a row with the rest of the world. That you can't explain simply by saying, oh, it's efficient, it's comparative advantage. We focus on the stuff we're good at, and the rest of the countries focus on the stuff they're good at, and we trade with each other. That doesn't explain why the U.S. imports more from the rest of planet Earth than it exports to the rest of planet Earth. Okay? So that's the point he's making, and the people who just keep hitting him over the head with, oh, well, you obviously don't understand Econ 101, is no. His point is you got to go beyond Econ 101. So to be clear, you can go beyond Econ 101. I'm not saying this is a deal breaker and this blows up the case for free trade, but I'm saying the people who just keep lecturing Oren and his fans and other, MAGA protectionists who are sympathetic to when Trump's talking about how great America was back when we had high tariff walls, that it's not correct to just say, just go crack open, Greg Mankiw's introductory book and you'll see it all spelled out for you. That's not true. Okay. And so you're not helping things. If you say false things, you're just going to convince them that, yeah, you guys are bluffing. You keep telling us this is what the experts know. I don't believe you on this the same way, I don't trust the experts on these 19 other things that I was lied to about. Okay. So saying that. Now what is true, I'll say one more element on this before going on the next clip. The standard free market, free trade response to this is to say, or that I've seen, is people will argue, yes, you're correct, Oren. In and of itself, yeah, comparative advantage by alone doesn't explain aggregate trade deficits. There, you need to realize the U.S., because we have strong property rights, we have diversified markets, very well-developed capital markets. Our government is, relatively speaking, very stable. It's got a large tax base. It's got a currency that, compared to other ones, has been managed fairly well. And so that's why investors around the world want to send capital to the United States. That in general, investors over the last few decades have wanted to invest more in U.S. dollar-denominated assets than Americans have wanted to invest in foreign, non-USD denominated assets. And so the way the accounting on this stuff works, the only way the foreigners can gain that net ownership in U.S.-based assets is if they send us goodies in the meantime. This is the way the argument goes. And so specifically, they'll say the U.S. capital account surplus is the accounting flip side of a current account deficit. All right, the current account, it's not the same thing as a trade deficit, but it's similar. Okay. And so that's the idea. And so again, I'm not inventing straw men. In the Law and Liberty, if you folks can read it, I'll put a link in the show notes page, discussion, people were sighing and lamenting that Oren doesn't understand, oh yeah, the reason the U.S. has a trade deficit is because we're so awesome and our economy is so great. So again, if you're somebody who voted for Donald Trump among other reasons because you think something's really screwed up with the U.S., and that's why you want to make America great again, meaning it's not great right now, to just tell them, oh no, the chronic trade deficits we've had over the last few decades, that's just a signal of how awesome our economy has been. Just a lot of people, that's going to ring hollow. Okay. And let me, I'll come back to that at the end. All right. So I have some charts to show, but why don't I move in to the next clip here, and then we'll circle back and I'll drive home that point at the end.
The dirty secret of this post-Cold War period is we're supposed to like globalization and efficiency and growth. Growth just keeps getting slower.
No, I know.
Investment keeps going down. In manufacturing, productivity has actually turned negative, which should not be possible in a capitalist economy. We are literally getting worse at making things. You need more labor in an American factory today than a decade ago for the same amount of output.
Okay, so here, let me again say that I had seen the reaction to Oren talking like this of people just beating him over the head. You don't get it. And the American workers making more now. Median wages are higher. And Okay, but my point is rhetorically. Clearly, there's lots of Americans who feel like they're not keeping up and that there are disturbing developments in the U.S. economy. And I don't think it's correct just to say, well, that's because you're a bellyacre. Okay. And so here, let me show you this particular chart to backdrop or underscore what Oren was saying. All right. So this chart is extraordinary. You can see over what it's showing is this is, government data, so take it for what it's worth, but it's inflation adjusted manufacturing output per labor hour. All right. So it's not just that they're taking an index of industrial output divided by the number of workers in the manufacturing sector. They're also accounting for like how many hours a week do they work, right? Because that could throw things if that changed over time. Okay. So you can see in the beginning, it was rising exponentially, which, makes sense. That's what you would expect, that year after year, especially over a long stretch, that in general, the amount of stuff per hour that U.S. workers produce in the manufacturing sector would go up. And that's what you do see. But then you see it just flatlines after the global financial crisis. And in fact, it drifted down a little bit such that Oren is correct when he's telling Tucker Carlson right now, U.S. workers in factories make less stuff per hour than they did 10 years ago. That's incredible that that's a true statement. Now, does that mean, oh yeah, see what happened? Letting China into the WTO and giving them most favored nation status was a bad idea? Not necessarily, because as this chart shows, China coming into the WTO and getting this, the most favored nation stuff, that was like around 2000, 2001 when that got approved and then actually got implemented. Okay. If you do, I'm not going to show you the charts here. If you look at a chart of the number of U.S. workers in manufacturing, you do see it falls off a cliff right when China does come in, right? So people like Oren arguing letting China in was a bad idea. That's not wrong, right? It's not wrong. He's not making stuff up when he's concerned about manufacturing output. That's what I'm saying, right? You can see the employment falls off a cliff, but nonetheless, the index of output continued rising after that. And only the two interacting with each other only really showed up that the amount of output per worker stopped growing after the global financial crisis. Okay. So I think the things that the Fed started doing with QE and all that, all the various regulations and things the Obama years brought in, and then also just the regime uncertainty, right? The fact that we don't know what the heck the government's going to do. That was a very uncertain, turbulent time. And maybe a lot of people stopped investing so much in manufacturing. And so that might have partly explained why the productivity of labor in that sector stopped growing. Okay, lots of possible reasons, but the point is something definitely is going on there with that chart. And to just say Oren is a crude protectionist, why don't you go back, hey, the mercantilists called and they want their worldview back. I don't think that's going to cut it in response to a chart like that. Okay, and then let me play one last clip for you.
So, we can't make everything. What should we make? So if you were in charge of reshoring manufacturing to the United States, what would be the industries that would get priority?
So I think there are a few that you really give priority to because they have some kind of unique strategic value, either for defense purposes or because of the way supply chains grow up around them. And so chips is a great example of this. Critical minerals, you mentioned the magnet, it's a great example of this. I think batteries, whether it's for electric vehicles, for electric grid generally, for all sorts of uses, is probably one of these things. And so there are a few particular things you want to identify and say, we have to have this. And that's where I would use what's called industrial policy, right? You literally say, we've decided this industry is important and government, people will call this picking winners and losers. It's not picking this company wins, this company loses, but it's picking, we actually have a point of view as a country that we want this thing. Beyond that, one of the things that's so great about tariffs, it's funny, I'm having a lot of fights about people with this right now because, in my view, tariffs are actually the free market approach. A tariff, it can be a very broad-based policy. You're not picking a particular industry. You're just saying, look, we are going to give an advantage to things made domestically. So whichever things make, relatively speaking, the most sense to make domestically will come back. The things that, relatively speaking, make the least sense to make domestically will stay elsewhere. We don't have to tell people what to invest in. We can just tell people, all things equal, we're giving a 10% advantage to making things here. Now go. And I think that creates a much healthier economic system. It's much closer to Adam Smith's invisible hand and means we have to have less regulation, right? We don't have to go around figuring out, what's every other country doing? What do we have to correct this way or that way? We don't then have to say, and let's not forget all the losers. We have to now have a whole other set of programs to help everybody who isn't succeeding because we don't have this stuff. We just say we actually want to have a free market in the United States, but it has to be one that makes things. And so we hereby give an advantage to whoever wants to make something here. And then, as the Chinese would say, let the flowers bloom.
Okay, so here, just real briefly, I'll just explain that it's ironic that Oren is taking this tack because in a previous life, I knew him before he got into this protectionist stuff. He was one of the leading critics of a carbon tax. All right. And he went through and showed, all the reasons that were offered in terms of, there's this negative externality from carbon dioxide emissions. And so we just need this corrective carbon tax. We're not picking winners and losers. We're just, sort of correcting for this general thing. And hey, Washington's not saying whether the industry should rely on solar panels or coal or natural. We're not picking anything. It's just we're correcting for this imbalance. And then let the market decide. And again, Oren was one of the key people. That's when I got to know him because I was in the same space, going through and showing why that was a seductive argument that really didn't hold up when you looked at the facts, right? So it's a little bit ironic that he's now taken that terminology and flipped it over, that he's identified this other ostensible externality, negative externality of industries not taking into account the full picture, and all they're narrowly focused on is their bottom line and not realizing that, it would help the American people in general if we had a bunch of chip manufacturers located in the U.S. and and we're just going to go ahead and correct for that imbalance with this little modest tariff in place. Right. So specifically, as I recommend people do, like if you're arguing with someone who's in favor of a $30 minimum wage, a good starting move is just to say, well, why not $300? Now, to be clear, that's not a conversation ender. They may have a good response to you. They might say, because at $300, this would happen. But you can see how scaling that back at $30, the benefits still are better than the cost. They could come back and say that. But it is good to push them just to get them to identify and acknowledge that, yes, if you had a $300 an hour minimum wage, that would be bad because there presumably are some downsides to this. And so likewise, I could say with Oren, why is the 10% tariff the optimal free market solution? Why not have a 10,000% one? Okay. And then presumably the answer would be, is because there are some things that it really does make sense to make abroad and not make them domestically. And we wouldn't want to, penalize importing that would make Americans worse off. And so they say, okay. And so those principles are all still in play at the 10%, right? And that's what the argument is for the free traders, is to say the right balance, like to figure out the pros and cons of whether something should be made in a foreign country or made domestically, is the market price. That does take into account all the relevant information. Okay. And that, anyway, Oren saying, no, I think there's these other elements they've left out. Well, among other things, you could say that about anything, right? That's kind of the central planner's hubris, okay? And Oren didn't buy it when the carbon taxers were saying all the reasons they thought industry needed to have this paternalistic oversight coming from Washington. And so hopefully he can see why many of us remain skeptical that Oren knows better how to plan the global economy than decentralized markets do. Okay. in conclusion here, let me just show two charts, because to follow my own advice, people might say, okay, yeah, Murphy, you're telling us tariffs aren't the answer, but something is going on. What the heck is it? So here, this is recycled. I've given this material in other Human Action episodes, but I think this is a good place to wrap up on, just to underscore. So here we see the annual U.S. trade balance going back to 1929. And you can see after World War II, it was a bunch of surpluses up until 1971. All right. So specifically, I went and checked the Excel file to make sure that my, just eyeballing it is accurate. From 1946 through 1971, there was only 1 year where the U.S. had a trade deficit. And in that year, the deficit was only 0.2% of GDP, right? So basically balanced trade. And then from 1971 through the present, there have only been 2 years where the U.S. had a trade surplus. And they were early on. They were in the 70s, close to that. I think once you go past 76, it's nothing but trade deficits. Okay, so you can see from, the start of Bretton Woods up until it ended, the U.S. basically had trade surpluses. And then once Bretton Woods ended and Nixon closed the gold window in 71, we've had basically nothing but trade deficits. So my point is, something is screwy with the U.S. economy, but I think it has to do with the money, not, we had high tariffs in the 50s and 60s, and then Richard Nixon foolishly gave us free trade in 1971. That's not what happened. Okay, and then last point I'll make here, more specifically to understand, what's the mechanism underlying this? Why would untethering the dollar from gold lead to an explosion in trade deficits? Well, one way to see it is this last chart. And that is contrasting the net international investment position. So that's showing, it starts out roughly balanced and then it just falls off a cliff. That is showing how much foreigners own on net of U.S. assets than vice versa. And you can see that's the mirror image of the explosion in the gross U.S. federal debt, right? The U.S. federal debt rose a little bit faster than the U.S. net international investment position collapsed over the last few decades, but they're close to the same. So to be clear, I'm not saying foreigners were the sole recipients of U.S. Treasury debt, but U.S. Treasury debt is fungible. And so I'm saying to the extent that American households or institutions loaded up on treasuries that, in a sense, siphoned their savings away into government debt as opposed to private vehicles. And so Americans didn't have as much savings left over to invest in foreign assets because it was getting sopped up by Uncle Sam borrowing it. And so I'm saying in the counterfactual, where if the U.S. government had run balanced budgets, maybe not year to year, but, over time, cyclically, where they had some deficits, but then some budget surpluses, I think in that counterfactual world where the U.S. government's debt right now was no higher than it was 30 years ago, I think you would see a much better U.S. net international investment position, and that you would not have had such large trade deficits through those years. Because intuitively, if foreigners are on net acquiring, let's say, treasury securities, which, are claims on future U.S. income, cash flows, what are they giving us in the meantime? And if Americans don't have the savings to, invest in foreign assets, to, invest in Japanese stock or real estate or something, they're sending us goodies. And that's how they're paying for it. Okay. And so you see how these things are all interconnected. So big picture, I'm saying if the U.S. went back to having hard money and the U.S. government stopped borrowing so much, I think you would see a drastic turnaround and that the trade deficit would disappear. Okay. And that, so, isolating the fact that it's not free trade per se that's the problem. The issue is not that, Americans aren't having their imports taxed highly enough. That's not the issue. That's not a problem. But there is a problem. There are structural issues with the U.S. economy, as I think those charts that I've shown this episode have demonstrated. Okay, well, I'll wrap up there. Big picture. The people like Oren Cass, I think, know something is screwy with the U.S. economy. U.S. workers in general are being left behind, and there are policies that could be changed to fix it. Tariffs per se, I don't think are a good idea. But the response to them is not just to say, you don't know economics, you're an idiot, the U.S. economy is awesome. I think that's a mistake strategically. Okay, folks, thanks for your attention. See you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.